Welcome to today's exploration of green financing, a transformative approach that combines financial return with environmental responsibility. Imagine a world where your investments not only generate profit but also contribute to creating a sustainable and healthier planet. That idea is at the heart of green financing, a sector that is rapidly gaining traction in the financial world. Let us begin by understanding what green financing truly entails. At its core, green financing refers to the funding of projects that are environmentally friendly. Think renewable energy initiatives, sustainable infrastructure, and conservation efforts. It aims to foster a shift in the global economy towards a pathway that minimizes ecological impact while addressing pressing issues like climate change. In essence, it's about investing with a purpose. Why is green financing so vital? With the Earth's natural resources dwindling and pollution levels rising, the need for sustainable development has never been more urgent. Governments and corporations are increasingly realizing that traditional business models are unsustainable in the long run. Green financing offers a solution by directing capital towards ventures that create a positive impact on the environment. Financial instruments like green bonds and sustainable investment funds have become popular as they cater to investors' desire for both economic and ecological returns. Let's delve into how green financing works in practice. Consider green bonds, for example. These are fixed income securities where the proceeds are dedicated to funding environmentally sustainable projects. Since their introduction, green bonds have skyrocketed in popularity and become a linchpin in climate finance strategies globally. Yet, green financing isn't limited to bonds alone. There's also private equity, venture capital, and even retail investments aimed at fostering innovation in clean technology, energy efficiency, and reducing carbon footprints. But how does one evaluate the effectiveness of green financing? A crucial role is played by ESG criteria, environmental, social, and governance standards. These criteria provide a framework for investors to assess the sustainability and ethical impact of their investments. By evaluating companies based on ESG benchmarks, investors can ensure their funds are directed towards businesses that uphold environmental stewardship, ethical governance practices, and societal well-being. Thus, ESG considerations serve as a compass guiding investors towards impactful financing choices. Though promising, green financing does face challenges. There's still a lack of universally accepted standards for what constitutes a green investment, leading to risks of greenwashing, where companies claim to be more environmentally friendly than they truly are. However, international frameworks, such as the EU Green Finance Taxonomy, are taking shape to address these issues and bring more credibility and consistency to the field. In closing, green financing opens a pathway not just for a prosperous financial future, but a sustainable one. As more investors choose to align their portfolios with values of sustainability, the shift towards a green financial market promises not only economic growth, but also the preservation of our planet for future generations. By investing with a purpose, we have the power to drive systemic change and pave the way for a truly sustainable economy. Isn't it time we rethink our investment strategies and contribute to a future where profit and purpose walk hand in hand?